Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. It's just gone 12:15 PM on Friday the 5th of February 2021 and we're going to spend the next few minutes looking at the US stock market, specifically the S&P500 via our proxy, the SPY SPY. Now I have been using the ES1 recently, but the count's got to such a point that with the post-market and pre-market futures market moves in price action has started to cause problems in the count. So I've kept that chart, we can always revisit it, but I wanted to look purely at the cash market. So we're going to use the SPY, and the reason we're using the SPY is we can get a look at those cash market movements, but we can also use our volume profile, which I'm just going to throw up here now, and then we can get underway. So if you're new to the channel and you're not used to seeing a chart like this and what we do here at Green Star Trading, let me just give you a quick rundown. We have our Elliott wave count, which is all the numbers and letters you see, and then we also have our volume profile on the right hand side. This is a visible range, so adjusts when we adjust the chart. Also has a built-in point of control with this yellow dashed line here. We have an RSI with a 10-day with a 10 close, with the oversold level being represented at 30 in green and the overbought level being represented at 70 in red. We have a MACD as well with a 10 for the short-term moving average and a 20 for the long-term moving average with a 9 to smooth. We also have 4 exponential moving averages built onto the chart, which is a 10 in yellow, a 20 in blue, a 60 in orange and a 250 in green, which are the long wavy lines you see here. Right then, so we're going to do as we always do on the channel. We're going to start with our basic technical analysis first and our Elliott wave analysis second. So let's clear the chart. We are going to move out to the weekly time frame for a moment, alter the chart, and we're just going to focus in on the more recent price action. Okay, so let's just pop over here and have a look. So a very bullish week so far this week, big bullish candle. We had this bearish engulfing candle the week before, which gobbled up these 2 previous weeks, but we've since come down to test the 10 exponential moving average here, which is the yellow line, and we're above the 10 and 20, 60 to 250s miles away. We basically came back down into this little node of volume here, found support, got back above the 10 exponential with the full body of the candle now comfortably sitting above it. Pre-market is currently trading above the close yesterday, which made a new all-time high for the S&P 500. So overall, technically on the weekly time frame, still looking bullish above all the moving averages. A couple of things I would point out on the weekly time frame here is we've got this short-term divergence between RSI and price. We've made a series of higher highs over the last few weeks, but a series of lower highs on the RSI. Now this is a bit of a running theme over the long term. We can see how the volume back in momentum back in August peak is still higher than where we are currently in the RSI, even though we're significantly higher in price. MACD almost crossed over, got this little tiny red bar on the histogram here, but didn't fully turn bearish and roll over. We're just basically kissing each other at the moment. The short and long term moving average could move higher. I suspect for today and into next week will move higher. I do believe we're approaching the top of the market overall. I've discussed that before, and we're going to dig into the Elliott wave count and have a look at that in a bit as well. So on the daily time frame, still above the 10, 20, 60, 250 exponential moving averages. We can see how once again we've got this high here in the RSI, a lower high in the RSI, and another lower high now. This divergence could disappear if we have a very strong bullish move up to the upside, but it still exists for the moment. That divergence is more extreme on the daily time frame between the highs set back in September, as you can see here, and the lower highs over here, even though prices continued higher. MACD showing the short-term moving average crossing back over the long-term moving average. First little green bar being recorded on the histogram from yesterday, having lost that bearish momentum, so likely to cross over and push higher in the short term. How much higher? Well, there's a limit on that as to how much higher it could potentially go based on our Elliott wave count, which we'll look at shortly. So actually, let's just pop out to the weekly time frame now. We'll start doing that. We're going to bring up our Elliott wave count, and we're going to full screen the screen for a moment, and there's a few things here I want to show you. Now, first thing I want to do is we're just going to shift the fib channel here out of the way for the moment, so we can have a nice clear look at the count. So going all the way back to the bottom in 2009, I count the move up to the top currently in this 5-wave structure. Cycle wave 1, 2, 3, huge expanding triangle in the fourth, A, B, C, D, E, and a very violent move up in the fifth to what I believe is very close to the top currently. Now, I just want to show you some geometry of the market here. So if we just get rid of that wave again, and I'm just going to bring back, first of all, a pitchfork, and we're going to bring this pitchfork in, and we're going to switch. Now what we see here in price action using the 1 and the 2 is the high, swing low pivot for the placement of the pitchfork. We can see how it basically contains the geometry of the market very well, with our 1, our 3 and our 5 near the top here. We're approaching the outer bound of the pitchfork, having underthrown it in the fourth here, and now we're overthrowing it slightly in the fifth. If I just bring up the RSI, one thing I like about this count as well is how our cycle wave 3 should be where the peak of our momentum is, and you can see here with the peak, with the 3 at the top of this pitchfork, or well near the 61.8 bound of it, we can see that we peak in the RSI. This is the highest reading on RSI during the 12-year bull market so far, which is 95.41. So given all this excessive bullishness we've seen lately in this big move up, we still haven't reached the same level of that momentum peak all the way back in 2018. So, you know, from 2018 now into 2021, we've seen a high, a lower high, and a lower high in the RSI, and a high, a higher high, and higher high in price. So this long-term bearish divergence is still present. Right then, so let's just turn that pitchfork back off for a moment, and I'm going to bring our fib channel back up. Now, what I really like about this is if we just switch the chart into log for a moment, and then let's full scale the chart again, we can see that using our 1, we find our 3 right at the top of the channel, and using our 1 and our 3 to project our 5. Now we can see that we're closing in on the top of that channel. Now I'll leave this up so when we zoom into the more recent price action, you'll see there's some serious confluence going on up here at the moment, and we're going to talk about that. We can also see that we take our 2 to find our 4, but we have this big underthrow in the fourth. So we peaked in momentum in the 3, we had an overthrow in the primary 3 of the 3, which is quite normal to see in the fib channel, and an underthrow in the cyclical 4. Right, so I do believe that people are incorrect to be calling this short-term move down, which is the last and final wave, the E wave of the ABCDE of the fourth. People seem to think that this was a bear market. This lasted a few days, it wasn't a bear market. Okay, the bear market here, which lasted from July 2000 all the way through to the start of 2003, that was a bear market. The move down here from October 7 all the way down to March of 09, that was a bear market, and we've had longer ones in the past. This thing lasted a few days. I don't think it was a bear market. I think it was simply a part of this 5-wave move up, and it was the completion of an expanding triangle in the fourth, and we are now approaching the end of the actual bull market, the longest one in history, very soon, I feel. So we're going to stay in log for the moment, and we're just going to come down to the daytime frame, and we're going to zoom in on the more recent action here. So I'll talk you through the Elliott wave count on the shorter time frame. So I've got this as a actually, tell you what, let's just come out to the bottom. So looking at the shorter term time frame from the March low last year, we've got 5 waves, 1, 2, 3, 4, 5. Very short wave 2 retracement. This is quite common in this bull market, and has been the whole time. There's just been such an underlying bid in the market that you can put the 1-2 here as a primary and jig around the count instead of the intermediate 1-2, but I prefer it with it here. No overlap in the 4, the 3 is longer, so there's no problem there either. And now we've done an ABC flat pattern in the fourth, and now we're working on the 5th and final wave on primary degree, so 5th of the 5th of the 5th, so on and so forth is what I think we're doing now. So let's just get rid of that wave count for the moment, and we're going to have a clearer look at what's been going on since. So we've got a fib channel here built off of our intermediate wave 1, 2, which has accurately predicted our intermediate wave 3, 4, and contained all of the price currently inside of this channel as we move up. So let's come down to a 2 hour, get a clearer look. Let's just switch it off log for the moment. We can always put it back on in a minute. So 1, 2, 3, I'm saying now, zigzag into a 4. Now you can look at this in 2 ways. This 3, 4 here. If you could look at this as another expanding pattern in a fourth. So if I just show you what I mean, we could have been going from here along like that, and along like this, and you could have a you could have another pattern on the smaller time frame of A, B, C. We're coming in to do the D, and then we're going to come even lower to do the E, and then 1, 2, 3, 4. Now the problem with this is you've got very little room to play with, because you'd be overlapping the 1, which is an Elliott wave rule. You could finish lower if we were to do this pattern, but it's a secondary idea. I'm not too keen on it. I've got it in the back of my head in case I want to apply it, but I've got this simply as a zigzag 3-4, because in this case we go from the top of the fib channel to the bottom of the fib channel, and we don't overlap the 1, which is represented by this white line here. So we've got a nice clean impulse wave, 1, 2, 3, 4. Now I can't do this in the Dow, and I do want to get a count out to you on the Dow, but literally any potential area where there's the 1, 2 and then the 3, 4, doesn't matter where you count it, there's an overlap. And it's not just an overlap on the intermediate time frame, it exists there on the minor for the minor 1, 3, 4, and also on the minute, and it's just a big mess, and I've been struggling with it. The only way I can get around it is to count it as an ending diagonal, a series of 5 sets of 3 wave moves in a fifth of a fifth, and that's the only way I can make it fit. But I can make an impulse wave here fit here on the SPY, so I'm sticking with that in the meantime. So the most important thing I've noticed about this move, this fifth and final move up, is we've got up here wave 5 intermediate time frame. Now this is a wave 5 limit. Now why have we got a limit on how big the wave 5 can be? The reason is the wave 3 is shorter than the wave 1, and the wave 3 cannot be the shortest wave overall in 5 wave move. So that means whatever the length of the 3 is, that is our limit for the length of the 5, and that's up here at 403.83. You have to move a decimal point across one, obviously, if you're looking at the price in the SPX. So it'd be 4038 rather than 403.83. Okay. So if we just show you what I mean, we come to the bottom here, pick out our 1, top of our 1, come down to the bottom of our 2, and we find that the wave 3 it makes it up to the 78.6, not quite to the 90% or 89% of the wave 1, does not make it to 100%, so it is shorter. We've got a 3 wave zigzag move down in the 4th, confirming a corrective move there. Unless we see that big expanding triangle play out, then we have to assume that wave 4 on the intermediate time frame is complete, and therefore our wave 5 limit is here. So the way we find that is by taking the length of our 3, having established the relative length to the 1, come up to the top of the 3, come down to the bottom of the 4, and sure enough, if I just get it in the right place, which I don't think I have, there we go. I must have missed one of the pivots ever so slightly, but it's right in the ballpark here. 403.40 it comes up here, but I did measure it precisely at 403.83, so the wave 5 cannot go beyond that point if the wave 3 is going to remain if the wave 3 is not going to be shorter than the 1 and the 5. So currently shorter than the 1, therefore the 5 cannot be longer than the 3. Has to stop before this point if this count is correct. This is the only count I've been able to make work in an impulse wave at the moment, and I'm happy with it. And let me just show you some of the reasons. I've already shown you on the long-term time frame why I'm happy with it, but if we just look at the short-term confluence here for a minute. So we had this pitchfork. Right, now we're right stuck around the top of this pitchfork at the moment, as you can see. As we've traded up, we met resistance here, we've come up right to the outer bound, and now we're snagging around it. We could put a top in any moment now based on this, but it doesn't have to happen. You can breach these long-term pitchforks or short-term completely and swing above the extremes and swing back in, so we could still move higher. But we have one reason here already. We also have our fib channel for the shorter term move here, which you can see upward resistance. But if I take the pitchfork off for a moment and I bring in on log scale, since we're looking at such a long 12-year move, that parallel channel, here it is, the blue line at the top. Now what you notice here is 3 areas of confluence. The completion of this fib channel, the small one, ends here at this point, or crosses over at this point with our limit for our wave 5, which also coincides perfectly with our 12-year long upper bound of the parallel channel here, of the fib channel. They all cross over here. So doesn't mean it has to finish there. It could finish at any time before that point. I personally don't think it will get up that high. It could do though. But let's assume for a moment that maybe the 3-4 isn't done and we are doing this expanding pattern. That would give us time to get to this point. if we were to push the limit before breaking down. Now, you could have a fifth wave which was more meandering and took longer to complete. That's perfectly possible as well. Maybe you come up here in a 1, then a 2, then a 3 up to here, then a 4, then a 5, and you have this long drawn out fifth wave, or maybe even an ending diagonal possibly. But we don't have to make it to this point. This is around March. We could turn around any time before then. We could come up, hit this top of this fifth wave here and retreat. We could hit the top of this one here and retreat. We could make it to the limit and then retreat. If we break above these fib channels and this outer fib channel and we take out this wave 5 limit, then this count off of this 3-4 primary is incorrect. Is basically that simple. I am wrong at that point, and you'll be having to consider the possibility that all of this would be a 1 above, then a 2, and we're into a whole nother level of wave degree in the bull market, which could run for, well, a significantly longer time than I'm expecting. It could go on for months, maybe a few more years. I don't think that's the case. I think the fifth wave would start to look ridiculous relative to the 1, and that's a traditional metric for comparing the wave 1 and the wave 5, and we've already pushed the wave 5 far beyond 100% parity with the wave 1 on the cyclical time frame. So it makes sense that we've got this limit up here, that we've got this confluence from the long term and the short term all pointing into the same kind of territory. Okay guys, so that really is basically it for the S&P 500 for the moment. If you're new to the channel and you've enjoyed what you've seen and you've liked what you've seen, please subscribe, smash the like, let us know what you think in the comment section below, and I will try and get back to you guys with another video soon. Very busy lately though, but all the best, take care of yourselves, and I'll speak to you soon. Bye bye.